So welcome back, and today we're going to talk about something that's going on underneath the indexes, and in particular 2021 has been a very strange year for the stock market. You look at the S&P 500, quite often it's been putting in all new time highs, but when you look below the surface, when you look at a lot of more stocks outside the S&P 500 and the stocks that make up a big weighting of the S&P 500, it's a different story. And quite a few of you guys might know, if you invest outside the S&P 500, if you invest in other stocks that are not called Facebook, Apple, Nvidia, you will know that the stock market hasn't looked as healthy as what the indexes would suggest. The indexes have been putting in, majority of the time, quite new 52-week highs on the S&P 500. Outside of that though, there's a lot of stocks that are down and down at 52-week lows. And today I'm going to just make this video to kind of reassure you that it's not just the stocks that you've picked, it's not just a certain few stocks, but it is a massive story going on underneath the indexes. And the amount of stocks that are not pushing 52-week highs are a massive amount. And also a little bit of a confidence of that this cannot continue forever. You know, at some point, stocks at 52-week lows, the only way they keep going lower is if their earnings, if their revenue, if they just keep decreasing. If they decreasing, then that will suggest, okay, that's probably a fair reflection on the share price over a long period of time. We're not talking 12-month period, we're talking a long period of time. If on the long period of time that company you invested in is decreasing its earnings, its revenue, then fair enough, this is a fair reflection on the share price. But the big thing you have right now is you have a lot of companies that are doing very good things and increasing how the company is growing, and the share price is moving totally in the wrong direction. So today I thought we'd do a quick overview of all this. Now this actually came from the Discord, so shout out to Ross on the Discord. He said that, a quote from a video I've just watched, I'm not sure which video it was, so sorry if I'm just totally ripping off the information on someone's video, but I would give you a shout out, but I don't know who it is. Last week when the S&P 500 closed at 52-week highs, 334 companies trading on the New York Stock Exchange hit 52-week low, more than double the amount that marks new one-year highs. That's happened only 3 times in history, all of them in December 1999. And when you look at the S&P 500, absolutely fantastic year. You know, the index has just gone higher and higher. You look at, in comparison though, to the S&P 600 and the Russell 2000, very different year. These indexes have really struggled to get into the positive direction, whereas the S&P 500 for the majority of the year has been putting new time highs in. Now my best performing stocks are the likes so far this year have been the likes of Microsoft. Microsoft has been a very good company for me this year, and it has returned 56%, so far outperforming the S&P 500. Another stock that I owned, I've obviously sold for profit now, which was Tesla. Once again, a stock that has done fantastic this year, nearly up 50%. Another stock that I own, which is Facebook, not as good as them two stocks, but still a very good year from Facebook, up 26%. Now, what do all these 3 stocks have in common? They have very big market caps, and as well as being very big market caps, they have made up a massive weighting of the S&P 500. So if we look into the weighting of the S&P 500, you can see that Apple makes up 6%, Microsoft 5%, Amazon 3%, Facebook 2%, Google 2.3%, Google Class C shares 2.2%, Tesla 1.5%, and then we've got Nvidia down here, Berkshire Hathaway and JP Morgan. By the way, I didn't even realize how good of a year Berkshire Hathaway has had until someone pointed out in the comments section a couple of weeks back, and I was like, wow, that's had a very good year. Well, you look at all these 10 stocks here, and the S&P 500 is supposed to be 500 companies, remember. Look at these 10 companies. If you add this weighting up to the S&P 500, these 10 stocks nearly control 30% of the weighting of the S&P 500. So when you have 10 stocks that make up nearly 1/3 of the index, no wonder that if these 10 stocks are doing absolutely fantastic, that the S&P 500 will go up regardless what the other 490 stocks are doing. That is the big thing. So when you look at the S&P 500 and it looks like it's been putting in new all-time highs and it's done absolutely fantastic, and if you own any of them top 10 stocks, they're probably one of your best performing stocks in the portfolio. When you look past them 10 stocks, and because they have such a weighting of the S&P 500, it does get quite ugly out there when you look at the Russell, when you look at the S&P 600. So the only way that you would have basically done very well this year is if you had a portfolio of just the S&P 500 index, or if you had only that and the big tech in there. So if you are outside of that, don't beat yourself up and think, oh, I can't do this anymore. Clearly I'm picking bad companies just because 12-month period has favoured just the big tech. At some point a rotation will happen, and I just wanted to make that video of like, just don't get too disheartened just because there's only been a few stocks that's put a false image on the stock market this year. And if you look at the other companies that I own in the S&P 500, they haven't performed that well, and this sums up what it's been like this year. All the stocks outside of the major holdings in the S&P 500 have done pretty awful. Visa, this is a massive company, a well-recognized company. Doesn't make the top 10, and what has happened to Visa? Well, if we go on year-to-date chart here, let's just go across. It's actually just up this year by 0.19%. Slightly up. But if we just pop back a few weeks, let's just go back to the start of this month. $190. Look at the 52-week close, $190. So this is a S&P 500 holding that I own outside of that Big 10, and only a few weeks ago it was at 52 close. And so it's not just small unrecognised companies out here, there's actually other major companies that are down at 52 close. If you look at Disney here, Disney's another stock that I own in the S&P 500. What's Disney done this year? It's actually down 12% on this year. And once again, this is a very recognised brand name out there and a company that's done pretty well this year. Now, the other stock I do own in the S&P 500 is Carnival, but we won't talk about that one because it doesn't really do much to with this video, because that just kind of goes up and down if depending on if cruise lines are any closer to being launched. But you get my point. Outside, the big tech, even recognised names outside the big tech have had a very poor year. It's not just small caps that have had a poor year. And this was the article that Ross was actually referring to. It's December 1999, based on the New York Stock Exchange shares touching new lows. This article goes on to see that they have seen an observation about a situation below the market surface. Last week, when the S&P 500 closed at 52 highs, 334 companies traded on the New York Stock Exchange hit a 52-week low. If we do go check the New York Stock Exchange out, there is 2,400 companies, because obviously we're not talking about the S&P 500 here. We're talking about how many companies are actually listed on the NYSE, and there's 2,400. So when you look here, and there is 334 companies. So if you have a few companies that are down, don't worry, because this is at 52 close. This is not including the companies that have had a very poor year as well, like your Disneys and Visas and everything like that. Even though they're not at 52 close, but they were very close to it, or they've put them in recently. 334 companies. Like I said, if we go on how many there is, 2,400, that's over 10% of the companies on the New York Stock Exchange at 52 close, when you have something like the S&P 500 at 52 highs, which is absolutely bonkers right now. And that's happened only 3 other times in history, all of them in December 1999. That's just absolutely crazy to think that even though the S&P 500 is doing so well, so much of that New York Stock Exchange is down at 52 close right now. And it's not just a 1-week phenomenon. New York Stock Exchange new lows now also outnumber new highs on the 6-week moving average basis. The last time that happened as the S&P 500 hit a 1-year high was in July 2015, right before a 6-month correction that saw the indexes lose around 14%. And that's really crazy to think about, that we actually have more new lows than new highs on a 6-week moving average, when you have the S&P 500 putting so much highs in right now. Now, it does go on to say that this is not potentially saying that we are going to enter a correction or a crash, but it did finish off with, the trouble is these warnings can persist for several months before the blue chips finally take a hit. Now, I think that's a very fair comment. I feel like when I do look at these sort of companies here, a lot of these are historic high valuations, and I do feel like at some point these do need to have a cooling off period, and they do either flatline for a bit or they do drop off in value. Whether or not that rotates into a lot of the smaller market caps, we will see, or if that does take the small market caps slower, I don't know. I don't want to predict things that I'm unsure on. I'll just be speculating, I'll be just guessing and not giving you actual facts. So yeah, I don't know what will happen there, but there is a very big disconnect going on here, and it's important not to think, oh, you're doing a terrible job because the S&P is going up and all these big tech are going up. There's so many companies out there that have had a different story in 2021 to what these indexes and these big techs would suggest. So don't get too disheartened on what has happened over the last few months. rather than thinking, okay, what is going to happen in the long term with a lot of these companies when they share price starts moving in the right direction. Because if the financials keep improving, these companies will one day go back to moving in the right direction. There's certain stocks that will not keep going lower as the company keeps on improving, and that's the big thing, is looking at thinking, okay, don't focus on the company here and what the share price is doing. Look at the business inside. Is everything moving in the right direction? Now, an example of that, and judging not what's happening on the share price, but actually looking at the financials, would be a stock like Hims. Hims is a perfect example. It's currently trading on the New York Stock Exchange, and this company right now is very much near 52 close. You can see here it has 52 close of $5.47, and it's currently $6.08. Now, it did recently put that new 52 close in only a couple of weeks ago, and this is one of those companies that you'd look at and go, this is not a fair reflection on how the company's performing, and just sums up, what the stock market's been like recently. There's quite a few that I could put in here, but I think Hims is a very good example of that. So Hims is currently now valued at 1.19 billion. Now, over a year ago, this was actually came onto the stock market through a SPAC, and this was valued at 1.6 billion. So in 1 year, the company has lost a lot amount of value. It's gone from 1.6 billion down to 1.1 billion. So it's lost a lot of value from that point of view. And when this company was private in January the 29th, 2019, so this is nearly 3 years ago now, the company was valued at 1 billion. So this company is basically the same valuation as what it was back in January 2019. Now, this is where it becomes important not to look at the share price, because when you look at the share price, it looks like this company has had a horrible year. But when you actually look at how the company is performing, okay, let's go back to when that valuation happened. So when it was the private valuation, you can see here the company was doing 26 million. Now, when they came onto the stock market, we'll have a look at what they did here. They did 148 million. So when you look at a valuation, you'd think, oh, this company's had a terrible year, so the company's not improved at all. Let's have a look at how the company's done. It's gone from them doing that amount of revenue up to 264 million. So the revenue has increased a massive amount, and even losses aren't as much as what it was previously. Now, the big thing, what you'll see quite often with a few companies like this, is that the companies that have been here are the companies that are currently not making as much profit as, say, these stocks, and it has seemed like this year has been a rotation into very safe plays. But when you look at a company like Hims, you have to accept that it is going to make some losses because it is taking market share and growing that revenue. A company like this, you would look at this company and go, they can be profitable if they wanted to be, but they want to continue growing the company. And it just seems like this year has been one of those years where people have rotated out of these small market cap stocks, stocks that are a lot more volatile, and they have just moved into the safe plays, and a lot of these safe plays have just carried on going up in value, and gives that false image on the stock market that you think the stock market has been a very good year, but if you have anything outside of the S&P 500 or the big tech, then you're like, has it? But don't worry, this is one of the strangest years that I have been in the stock market. I've not really seen a big massive disconnect like this before, and don't get too upset. It's not just a certain few stocks, it's been a lot of the stocks out there, and you just got to look at this and go, is this going to be a disconnect that happens forever, or do you feel like there's a lot of companies out here that are at 52 close, you're looking at that stock going, but everything's going well with that company, everything in the company is moving in the right direction, and now you're valuing it a lot lower than what it was a year ago. And if you see them opportunities, quite often those stocks are the amazing buying opportunities out there. And when the stock market starts moving back in the right direction, or Wall Street and investors want to come out of these safe plays, because you do look at some of these stocks and go, there's generally people still buying Microsoft at $333 at a price to earnings of 38, the highest it's ever been at. At some point, people will move out of them safe plays, and they will come back into favour. And it's more, not looking at what's happened over the last year, but thinking about where you think that business will go in the longer term. And if you go in the longer term, these trends that are very strange at the moment will move away, and a lot of these stocks will get recognised as like, oh, that's a very good investment, I should be buying that. So it has been a bit of a strange year, and I just wanted to make a video kind of summing that up. And it's one of those that, just don't get too upset if you've had some investments that haven't had a good year, and also that more than anything, some of these investments right now at very good valuations for very good companies, and will be very good companies in the next few years as they continue to improve their financials, and that will be reflected in the share price in the long term. So hope the video was useful anyway. As always, if you can hit that like button, that'd be absolutely amazing. If you're new, subscribe, and I'll see you on the next video.